good morning, everyone. Wanted to thank Sue for so eloquently setting the macro scene for us to then talk about what that means for financial markets, how different asset classes will behave in this new regime that we've heard about, and then as a guardian of our clients' capital, what kind of investment solutions might we need to design in order to meet our clients' objectives in the years to come. So if I was to summarize, the themes that Sue talked about, deglobalization, reshoring, resource scarcity and competition, demographic challenges, and what that means in terms of higher inflation, less predictable inflation, more volatile inflation, but also how fiscal policy and monetary policy rebalance and then react to each other. I wanted to ask you first, Luke, what does that mean for how markets behave, the dynamics of markets, and then specifically how investors react to that? And then finally, just to start to talk about what kind of fund management solutions we might need to have available to our clients in that backdrop.
Thanks, Mark, and good morning, everybody. So that's quite a lot to unpick. Okay, so bear with me as I try and set the scene and go through this. I think the starting point for me is not just being forward-looking, but understanding where we've been, certainly in the sense of investor behavior. And I think if we look back over, frankly, the past decade, there have been particular themes that have dominated in markets. We have been in a 30-year bull market. We have seen zero interest rate policy. That has led to growth as a factor outperforming pretty much all else. Now, aligned with that, and it was wonderful listening to Sue. I think we're extremely blessed to have such a deeply resourced and thoughtful macro team. The reality is, over the past 10 years, macro has not been a driver of many of our asset allocation decisions. It didn't need to be, and it was dominated by these other factors that I'm talking about. We're not there anymore. I think the concentration into specific positions, US equity markets, growth, fixed income, we're not there anymore. I think the future and the market dynamics are going to be characterized by increased volatility. We're going to see more dispersion across asset classes. Now, in one sense, and Sue touched on this, that leads to volatility. Now, volatility, for me as an active investor, is not something to be afraid of. It's something to be embraced and actually affords us opportunity. And I think the benefit of having a diverse investment set, being able to move across specific themes, take advantage of investment opportunities as they arrive, is the way that, to Michael's point, we are going to be able to deliver investment performance and resilience across those solutions. Now, what does this mean in terms of what we're seeing from our investors? What are they concerned about? Well, there's certainly one theme that comes through, and speaking to many clients, a big challenge, frankly, is that cash has returned as an investment opportunity. Now, if you couple that with the comments on volatility, it's of course completely understandable that investors would have a particular affinity to hold money in cash as a secure asset, all of a sudden generating a return. But I have a problem with that. The reality is, for many markets, holding cash has locked in a real return that is negative. I don't like fixed losses. I actually like to generate returns. But using cash and cash-like instruments as a component and being able to navigate where you take your exposures, certainly within a multi-asset context, is a much more powerful tool that we haven't seen for many years. Now, along with that, our clients are telling us that one theme persists, certainly in the Asia environment, which is the need for income. How do you deliver income? Which asset classes do you want to take exposure to? Which asset classes and which rotation of them is going to deliver a consistent, reliable return, whilst at the same time affording the opportunity to benefit from capital and real return growth. The other thing that we're seeing is a recognition that, going back to those comments of having a very concentrated and factor-specific exposure, is not going to serve you well in the future. We are seeing increasing asks for us to include alternative asset classes in our exposures where we can. Now, that includes going beyond and going deeper in terms of traditional asset class sets, but also embracing different approaches, whether it is the use of derivative strategies to recurate the risk and return profile of portfolios, whether it is to look into private markets. All of these are common themes that we are seeing across the globe. Now, in terms of the solutions that we're being asked about and to deliver, as I say, the anchor for me are those sort of core income portfolios. Now, I absolutely see the need to have that core and then complement it with specific satellites, take advantage of those opportunities as we see them coming. Now, within that, I firmly believe that flexibility to be able to move around the globe, move around asset classes, and also being active and dynamic in those exposures. A buy and hold strategy, I do not think is going to achieve the outcomes that people are looking for. So that's sort of my 10,000 feet view.
Thank you, Luke. Very comprehensive. Asking a similar question, but in a different way. In investments, we often hear about the mantra, follow the money, which means align yourself with the flow of capital, both away from certain asset classes and markets and towards those markets which are receiving those flows. If we go back to the real world and what we've been seeing in the investment landscape in the last 6 to 12 months, where are you seeing capital flows going into, and does that align with the views that you've just talked about in the previous slide?
I certainly hope it aligns with my views. Otherwise, I'll be in trouble. Look, capital is moving around much more rapidly and with a far greater velocity than we have seen in recent history. I do think these macroeconomic trends that Sue has talked about is the compelling driving factor of this. Now, we see shifting views and shifting tolerances for our investors. Key themes have been the US market, particularly in equities, has shown a degree of resilience relative to other markets, so capital has shifted that way. US dollar, of course, and this is one of the reasons why you see US dollar strength, not just the Fed's monetary policy, but shortage of US dollar assets has led to an appreciation there. We're also seeing capital move to different parts of the capital structure. And just an example of that, if you think of any company that has a public equity listing, but also has different levels of debt, whether it is the senior unsecured, subordinated, contingent convertibles, preferred securities, all the way down into the equity market. So you can be much more selective of where you want to be in the capital structure. And again, rotating through those asset classes is important. The other thing that we see is that there is a huge sensitivity, and quite rightly so, to the geopolitical risks that we see out there. Europe is obviously a case in point. Obviously, the issues and tensions that we see with Ukraine, Russia, and that spills over into those markets. On a forward-looking basis, many of our clients are asking us, what can the Eurozone do to emerge from this? And a big challenge that they have, and as I always say to investors, we talk about the Eurozone as a single block. It's a frustrating thing for me being based in the UK and understanding Europe in the same way. I get very frustrated when people think of Asia as a single block. It's not. There are discrete opportunities, discrete economies, and discrete behaviors. And for Europe, there is a clear north-south divide. ECB policy isn't terribly helpful for Southern Europe. Italy is an example that I always use, that you're getting to a point now where the cost of funding in Italian government debt, because of the level of debt, because of the lack of growth, or at least it's anemic, potentially makes Italy as an economy somewhat unsustainable. Now, the other thing that we're seeing, of course, is that these elevated interest rates are making asset classes that previously have been out of favor due to lower returns much more attractive. And again, this just lends itself to that more dynamic rotation that we're seeing between equities, fixed income, alternatives, and indeed currency.
Thank you, Luke. Let's move the conversation on to think about how to consider different asset classes in different macroeconomic regimes, their sensitivity to growth and inflation backdrops. And then this starts the conversation on how to package those various asset classes into the eventual solutions, which we'll come on to talk about. So Chris, can I ask you to present this framework for the audience in terms of how you think about the different asset classes at our disposal?
Sure. So as we think about asset allocation, we like to think of this framework that you see on the screen here, which helps us to define the function of how asset classes should or have a tendency to perform during different macroeconomic cycles. So along the x-axis, we have inflation rising or falling. So as you see, anything on the right side of this page tends to be asset classes that tend to do better as labor markets are tightening, as output gaps are closing, or in other words, as inflation tends to be rising. Along the y-axis of this chart is generally more tied to the business cycle, as growth is either improving or falling. And so as we look through and think about resilient solutions, we think it's important to have exposure to a number of these different potential macroeconomic regimes. It's a bit like assembling a sports team where you're going to be needing to call on different players to come in and execute depending on the situation. For example, rising growth and rising inflationary environments, that's typically natural resources and real estate's time to shine. On the lower end of this quadrant in the red box, falling inflation, falling in growth, that's typically as the risk, the inflation risk premium and interest rate risk premium is falling. That's when you're starting to see nominal bonds start to outperform. So as we think about this framework and where we have been over the course of the past 20 to 30 years, we have primarily been operating on the left side of this page in the falling inflation zones, where growth has been either improving or decreasing, but generally inflation has been low, falling, stable around the world, which has led to very strong performance from traditional asset allocations. But as we look forward, I think it's important to remember that the right side of this four-quadrant system does exist. And in case Sue's presentation wasn't convincing enough, I think we did get a strong reminder of what types of asset classes do tend to perform in inflationary environments during the most recent period of 2021 and 2022.
Thanks, Chris. Let's move the conversation on to real assets. They're very topical. They offer somewhat of a diversification to more listed assets and traditional asset classes we talk about. Perhaps you could take the audience through the observed behaviors of different real asset classes in both rising and falling inflation environments.
Sure. So I think first, just to define what exactly a real asset is. And so as we think about real assets, these are defined by any asset that is defined by its physical substance or properties. So an example in a liquid format, which we tend to utilize, would be natural resource equities. These are companies that are involved in the processing, resourcing, refinement of raw materials that we all use, places where we live, work, and how we get around. Other examples would be infrastructure assets. These are typically large scale, difficult to replicate types of companies such as utilities and utility grids that obviously power our houses and our offices. This can be contrasted with more of an intangible asset, like a piece of software or an app on your phone, which doesn't really have a physical element. And so the reason that real assets tend to perform better during inflationary environments really comes down to a key component of real assets and their physical element is the element of scarcity. So supply and demand drivers don't always move at the same pace. One example that we're seeing right now is a trend towards decarbonization. A critical component in that transition is copper. Copper is a critical component to transmit electricity across a number of renewable energy sources. So the demand is strong for that material. But you can't just up and start a new copper resource. It requires permitting, potentially making agreements with local communities, potentially having to establish new trade developments or trade ties with foreign partners. This is a long and lengthy process that can take many years to provide the supply response to something that has a currently faster moving demand. So in those types of environments, the remaining lever that is there to move is price. And that price during these inflationary environments that we've outlined so far is usually what then accrues to the physical real asset.
Thanks, Chris. now we start to think about blending real assets with listed assets, financial assets, if you like. How do they behave versus each other? What have you observed in terms of the correlations between these real assets or inflation beneficiaries versus traditional asset classes?
Sure. So, as we think about real assets, I just gave one example using the trend towards renewable energy, but we do see this empirically in how these asset classes perform as well. So what we have on this slide are showing correlations of a number of real assets and traditional assets versus inflation. These are annual figures, as we do tend to see real assets respond more to trends in inflation as opposed to small short-term tactical moves in inflation. But if I could highlight a couple of data points on here just to focus your attention. Towards the right bottom portion of this page where you see global equities correlation with US inflation is 0.1. So that indicates that there is perhaps some relationship with inflation, but it's not particularly strong. As you look across the x-axis of this, where we have composed a number of other real assets, you see that in almost every case, real assets offer a much stronger empirical relationship with inflation. Energy assets, which is in the column the most to the left, you see has one of the strongest relationships, 0.77 correlation with inflation. Another one that I would like to point out is global bonds correlation with inflation is negative 0.43. This should be intuitive, as sometimes nominal bonds aren't necessarily as correlated with inflation, as higher inflation tends to reduce the value of those bonds. So as we think about real assets and fixed income, we tend to think about fixed income assets that might be more sensitive to inflation, such as shorter term inflation-linked bonds, shorter term credit, or generally shorter term fixed income assets that tend to see their coupons payments increase as inflationary dynamics take hold.
Thanks, Chris. Luke mentioned earlier that we have a strategic view that the delivery of income will remain critical, but we have to be a bit more creative and diverse in terms of deriving those sources of income, particularly in an inflationary environment. When we start to think about the solutions that we've developed and where they source their income from, perhaps you could explain how you see the various, both traditional and non-traditional source of income and the relevance for these types of solutions.
Sure. So as we start to think about how income solutions can be delivered in different types of macroeconomic environments, we like to divide income sources up into what we are terming traditional income sources and then non-traditional income sources. By having a number of different income sources, it allows us to have more balance, more diversity, and more flexibility in terms of the income sources that are providing to the ultimate solution. So some examples of traditional income sources would be things like investment grade bonds, high yield bonds, emerging market bonds. These offer consistent, usually higher paying coupons, fixed payments that are geographically and thematically diverse. Global equities, particularly dividend paying equities, are also a traditional income source. These are paying regular dividend payments to their shareholders. Equities also offer the opportunity to build on your capital base that income for your total solution is ultimately generated on. Non-traditional income sources can serve as a nice complement to our traditional income sources. One example, preferred securities that act more like a hybrid security between equity and fixed income, offering significantly higher payouts often than traditional equities. Derivatives also offer potential strategies to earn income as well. These are strategies that can convert portions of equity market upside that may take months or years to accrue into current income now. So by providing, as we think about income solutions in different market environments, we think it's important to have a wide breadth of income contributors to the solution that ultimately allows it to be more resilient.
Thanks, Chris. And then we start to think about diversification between these different income sources, not just the asset classes underlying them. Could you just talk through, again, from an empirical perspective, how those correlations look, maybe how they change over time as well?
Sure. So as we think about all of our solutions, a big theme, as you're noticing, is that diversification is important to how we build all of our solutions, and income solutions are no different in this regard. All asset classes have certain idiosyncratic and systematic risks that can impact these income sources at any point in time. Energy equities, for example, tend to be a good income source. They often pay higher dividend yields and so find their way into dividend paying strategies. However, the sector can be more prone sometimes to geopolitical events. Fixed rate bonds also are a great source of income, and as we take a diversified exposure to a number of fixed rate bonds in our income solutions. However, they can be more subject to risks that are out of our control, such as policymakers lowering interest rates, which may reduce the income potential of those bonds over time. So as we think about how to build a durable and resilient income solution, we think it's important to have flexibility to flexibility to have income sources that are coming from a variety of places that can work in a variety of different types of market environments.
Thanks, Chris. Let's move on to the use of derivatives. So we talked already about the need to have flexible, dynamically managed solutions in a complex macroeconomic environment where things happen quickly, and then also the use of derivatives in terms of sourcing income. So maybe, Chris, if you could kick off and talk about in the global multi-asset diversified income strategy, how we use derivatives, and then I'd also ask Luke to join the conversation and also talk about his experience with use of derivatives in terms of deriving income and also managing risk throughout the market cycle.
Sure. So I'll start and be brief on this one, but within the global multi-asset diversified income strategy, we utilize two primary derivative strategies to generate income for this solution. One strategy we utilize is covered calls, and the basic structure that we use here is a long-only, dividend-paying, diversified dividend-paying collection of securities that pay out regular dividends. We then also sell call options out of the money that can provide additional income to this portion of the portfolio. The pro here is that we're offering the ability to earn income in more market environments than otherwise would have been possible, such as flat, down, or moderately rising equity markets. The con being that there may be some limit to the equity market upside we would have. The other potential strategy that we use are selling put options. This is also another way that we can generate income and serves as a complement to the covered call, as this tends to earn income during flat, rising, or moderately falling equity markets. So these serve as complementary strategies that can earn income in a variety of markets. Luke, perhaps I could pass it to you to offer any further insight you've got there.
I've always got something to say, Chris, you know that. All right, derivatives. So let's think about how we integrate this into a portfolio, because it is important to really understand the objective and how we manage things. So for the Gemadi strategy, the baseline is that we systematically deploy these derivative strategies, okay? Because we want to generate income, covered call side in particular, and on the put writing side, I also want you to think of how this actually behaves relative to equities. It is a more defensive way of taking equity beta exposure. Okay, let me just quickly explain why I mean that. If you think of just holding long equities, you've got all the upside, all the downside, simple to understand. If we hold cash and sell a put on an equity index, the upside is limited to the interest earned on cash, and as I said previously, that's much more relevant now, and the premium that you receive for the option that you have sold. Okay? To the downside, yes, we're exposed to the downside of markets, but because we're harvesting interest income on cash, because we're harvesting the premium, it's a more defensive positioning in falling markets. Okay? So we combine these two together, but this is not a simple fire and forget. Every month we're going to write options 5% out of the money on calls and 2% out of the money on puts. It's far more thoughtful. We are an active team. And within that, we're able to vary the strikes at which we sell the call options. If we are structurally bullish on markets, we can change the level at which we're setting those strikes. And similarly on the put options, we can adjust them. We also vary the tenor, so the time to expiry. And simply put, hopefully from my side, why would you do that? Well, the reality is, if you sell short-dated options, you harvest time value, okay? So selling 3 one-month options, you harvest more value than selling 1 3-month option. So there's lots of activeness we have in this portfolio. And then the final thing on the covered calls, which is important to tease out, there are innumerable ways of writing call options, single stock, index, etc. The approach that we're taking here is to have our long equity basket, our single stock, but the calls that we're writing are on indices and sectors. That allows us to be much more specific, much more dynamic in isolating where we want to harvest premium income and where we want to enjoy upside. Now, there's one, I know you want me to stop. There's one final thing that I would say on the options, okay? We've talked about where we're selling puts for defensive exposure, harvesting premium. Selling calls on equities we own. We also tactically deploy long option strategies. And why do we do that? Well, any kind of portfolio construction is anchored around your baseline view of how markets are going to move over a specific time frame. Much as I would like to say we get it right 100% of the time, I can't do that. We don't. Even with Sue's input. So, we give ourselves insurance policies. If we don't have sufficient conviction, or we see the opportunity for exogenous shocks, look at what the Fed has done, the market was too complacent, rates went way ahead of expectations, so we will also selectively purchase out of the money call options, especially when they're cheap. So if you do get a particularly aggressive rise in markets, we reparticipate. Okay, so it is simple in construct and context, but the detail behind it, I think, really demonstrates the activeness and the diversity that we have in this portfolio.
Thanks, Luke. I'm going to keep you talking on this subject for one more question that I have. We talked about how the volatility regime is changing. How do we adjust our approach towards using options in a higher volatility environment compared to the lower volatility environment we've come from?
Yeah, so really there are two choices here. Because if you think about what we're doing here, we're selling options, okay? And implied volatility, the market expectations of volatility is the primary driver of the premium we harvest. So a higher volatility regime means, all else being equal, we can gain more premium from selling our calls and more premium from selling our puts. But again, this is not a systematic strategy where it's 3-month, 105% out of the money strikes. If that broader dispersion, increased volatility that we are seeing, that allows us to adjust those strikes of the call options we're selling or the put options we're selling so that we can maintain greater participation to the upside in market should we wish to do so. So again, coming out of the sort of artificially suppressed volatility regime we've had through zero interest rate policy, for me, just affords more opportunity.
Indeed, it shows that the volatility is not something to be feared, but to potentially be embraced as well. Let's show the sort of the evidencing, the proof of the pudding. We've talked about a solution which sources income from a diversity of sources, diversified asset class exposures, both traditional and non-traditional. The Jemadi strategy that we've talked about, how has it fared in the last couple of years, which have been quite eventful for markets?
Thank you so much for giving me the 12-month performance statistic. So look, we deliberately use this slide to show the last 12 months. Okay. The reality is there is beta in this portfolio. You cannot get away from that. The way we think about Jemadi and other income strategies is that we are looking through market cycles. Okay, so typically think around 3 years. The last 12 months has been characterized by uniform decline in asset price values. And as you can see here, like all other participation, all other competitors or participants, we have suffered a decline in value. However, that's not the whole story. You need to look at the dispersion of those values. So if I look at Gemadi relative to the bulk of the peers, you can see that it's outperforming the vast majority. Why is that? Our global diversification, our non-reliance on a single factor, the ability to be dynamic in our options strategies and take advantage of opportunities when we see them. Now, there is one particular peer in there. Obviously, in this forum, we're not allowed to give names of peers, but I'm sure you can deduce them, who has had a very specific strategy running for some time that does have quite specific factor exposures. Okay. Now, as I've said, and as you've heard from Sue, on a forward-looking basis, we do not believe that such concentrated and specific bets are going to serve you well. So we're looking for Gemadi to enjoy a recovery as asset values increase, markets recover, and we wholeheartedly believe that this diversified and dynamic approach that we take is the way to deliver those sustainable income solutions that our clients need.
Thanks, Luke. If we bring it closer to home, for those clients that are looking for more of an Asian-centric approach to investing in this market environment, perhaps you could introduce the Asia Dynamic Income strategy that we have at a high level and some of its benefits.
Yeah, absolutely. So I think to start with, one of the questions I get asked is, well, you've got your flagship global multi-asset income strategy. Why do you need an Asia version? Well, for me, I think there are a couple of reasons for this. First of all, we understand our clients. We are very close to them. We don't just build things and construct portfolios without there being a demonstrable need for them. First of all, obviously, we have an enormous Asia client base. Thank you, all of you, for being here today. And there is a desire to focus on Asia-specific solutions because that's what many investors understand from a sort of day-to-day point of view. The second is we recognize that whilst we have the core global strategy, which can be complemented in client portfolios with satellites, we also need to provide those satellites. Okay, so two ways to think about why we constructed this portfolio. Now, the approach that we take here, I'll give the highlights. So this is an actively managed strategy. Clients benefit from the skill and investment expertise of three distinct teams. Our Asia fixed income capability, and Andre and Murray are going to be speaking shortly, our Asia equity capabilities, and of course the multi-asset solutions. Now, whilst these are, of course, discrete and distinct investment capabilities, they are seamlessly integrated into a single portfolio that the multi-asset solution team runs. So what do we think about? We're blending and combining the skill in bottom-up security selection with top-down asset allocation. Okay. Now, the way I run this portfolio is I've effectively given both fixed income and equity managers a benchmark unconstrained target. Deliver me the yield in a sustainable fashion that our clients are asking for. So they are unencumbered. And that's an important thing to bear in mind. I talked about opportunity sets, the dispersion we see in markets. A benchmark relative approach here, I don't think is going to achieve the best outcome. What we then do from a multi-asset point of view is we combine those positions. We look across the capital structure. We assess across geography, sector, company concentration to ensure we have the diversity we want. And also, we put tactical positions in the portfolio to reflect our near-term views, strongly influenced by the macro thoughts that Sue and team deliver to us. Bringing all this together, what we therefore end up with is a portfolio that is Asian-centric, security-based, so you're benefiting from security selection, with the ability to dynamically adjust market exposures to address both opportunities and risk management. We have a target income of 5 to 6% in this portfolio, so slightly less than the global portfolio, but it's one that we can sustainably deliver across all weather, frankly, and different market conditions. So, where do we think it's different? What's our edge? So, I think the starting point, and I've run through a few of these already, is that you do have the unconstrained security selection approach. Okay, that's different to many of our peers. The alpha generation that we have there, and combining high conviction positions that the team have across the capital structure is different to what you might see in other solutions. Furthermore, the use of derivatives that we have in the portfolio, and it's very different from the Gemadi approach because we don't have a systematic process that is a baseline. We're not always writing options or using derivatives. And the reason for that is, frankly, based on a quarter of a century of experience in investing in markets. Asian markets are different to global and developed markets. You will often see, and I'm sure you're all familiar with, gap events. The market moves beyond the extremes that have been expected or priced in markets, and I do not want to be exposed to them. So we're much more tactical, much more dynamic and selective in the instruments that we use. We're using it both to reflect investment views, and an example I would give is that we had I talked about Europe earlier and how it's not just one big block, and we put a relative value position in there that came from our global research process where we went long Spain and short broader Europe. Okay, so we can put RV positions in there as well. So just looking at the sort of equity styles and how we put all this together, aligned with my previous comments, whilst these are unconstrained in terms of security selection, we've obviously got guide rails around them. I do not want a portfolio that is dominated by a single factor or where the outcome we can deliver to clients is going to rest upon a particular or single investment theme. You're going to hear this a lot, I suspect, over the rest of the investment conference. Diversification is key. The world has changed. The investment opportunity set has changed. So what we think about here is that we want to blend opportunities in the new economy in growth, but at the same time, take advantage of the growth at reasonable yield, or GARI. So it's not just those cash flow burning, high value, high multiple companies. It's also looking at those, and obviously we have an example here of the tech hardware manufacturer that are still in that growth bucket to take advantage of the sort of secular trends and long-term themes that you might see. But they are cash flow generative, typically less volatility. Chris obviously walked through the approach to taking exposure to alternative asset classes, including REITs, and in this case, bond proxies as well. So it's traditional exposures, non-traditional exposures, but again, wrapped cohesively in a portfolio that you can have comfort is not just a buy and hold and is actually reacting and being nimble across market events and developments.
Thanks very much, Luke.